So you've heard the phrase, know your numbers. Well, in this video, I'm going to show you why knowing the value of your stock at your business year end is really important for your tax bill. As a business accountant, my team and I spend all day long helping business owners on their journey, and one thing we ask them a lot is for the value of their stock at their business year end. The reason for this is it's really important for your tax bill and also for the overall position of your accounts as a tool. So when you're growing later on, you may well want to use the accounts to be able to utilize and move around to help you grow and help you plan. And if your stock figure and the actual profit and loss account that we're going to dive into in a minute aren't right, you're going to get this wrong. It's not going to be useful for you. But more importantly, it affects your tax bill positively or negatively, quite often negatively, and I'm going to show you why that's the case in a minute. Now, like all these things and all these scenarios I talk about on this channel, there are caveats, there are examples where this isn't going to be the case, etc. But I've got to keep it really simple, as I always do, just to show you the basic impact in a very basic, general, common scenario. So before I get into that, if you like this video, make sure to click the subscribe button below to get notified whenever we release a video just like this. Let's get into it. So let's get straight into it then. So in this particular scenario, I'm going to start off with, we're going to sell wooden chairs. And I think that's, I don't know why, it's always to me just, I remember doing business studies many years ago and always picturing it in wooden chairs. So in this particular example, you can see we're going to sell them for £200 a chair. It's a pretty awesome chair. And we're going to sell 300 over the course of a year that makes £60,000. Each one of those chairs is going to cost us £40. So 300 lots of 40 quid means it's cost us £12,000 in chairs. And this is our quick maths. So, and we've made a profit of £160 a chair, which means we should make 48 grand, or this thing called gross profit margin, which is what is this figure as a percentage of your sales, is 80%. Now, if you want to see a video on that, we did a video previous in our Know Your Numbers series to talk about how important that is as a measure, but it just gives you an idea. So, you know, when we started our year off, we did a little bit of planning and what money we were going to make and how much we were going to make per chair. We figured this bit out, and then over the year, we should expect to see this result. Now, what's happened is our bookkeeper has then gone on, or us as the business owner has gone on and recorded all of the purchases that we've bought over a year. So we've gone in and keyed them all on our Xero or our QuickBooks or into our spreadsheet, and it's come out with a number. So if we flick over now to have a look here, this is a profit and loss and a balance sheet. Now these two documents are very important. They're the two key business documents that you have, and funny enough, we've done 2 videos of those on our Know Your Numbers series that talk about what are the important things you should be looking for. So do go and check those videos out. Now, so the bookkeeper's done it, and you can see here that they've put £6,000 of costs in for these chairs. That's what it said based on the receipts. So you've entered all of them, and that's it. Now, if you do the calculation for that margin we were talking about, we expected to see 80% here. So this should have yielded an 80% profit, and this should be around, if we flick back, should be £48,000 here, and it's not. Now that gets you thinking, why is it not? We've also had a quick flick over on our balance sheet, and it says we've got £8,000 of stock. Now, stock's normally recorded at the cost price you buy it, not the price you sell it for, unless the price you sell it for is lower. So normally it's cost. So if you divide that back, that's far too many chairs. You know, we should have that's 200 chairs. We should only have 50 by our count, and we should have sold 300. If you work that out at £40 a chair, we're only showing there that we've made 150 chairs really, or it's only cost us the amount it should. Now that it could happen, actually you had a slightly better year and you've bought lower and everything else, and actually you have made more money per chair, but in this case we're just going to keep it simple. And I should say, of course, for these type of videos, there's always multiple scenarios and caveats and everything else. I just want to keep it really, really simple. So there's less money here than expected. We're expecting to see that it's cost us £12,000 to make these chairs. We've got 6, and that's because we've got too much over here on the balance sheet. And this doesn't affect our profits. You can see at the moment we've got £36,000 there in profits. Now that's wrong. We know it's wrong because we know we've got too much stock here and we've not got enough cost. So what we've got to do is transfer some of the value from here to here. And actually, if you've been studying accountancy now or bookkeeping, you're probably going to scream at me for what I'm about to do, because this is not technically how you show it in the books, but it's far easier to understand it, is we're just going to whip some of it out of here and put it in here. So we know the position, we've counted our stock, we know exactly what we've got, and surprise, surprise, it matches up. We've got too many chairs here and they need to be transferred over here. So what we're going to do now is we're going to then go and adjust that. Now in your bookkeeping software, there's multiple ways of doing that depending if you use stock, but actually quite often it's done with what they call a journal that will just, or multiple journals if you're being really technically clever, and put it in there. But what happens is this, you move it off of here, So now we've only got £2,000 worth of stock, which is the 50 chairs that we should have left. And we've now moved this here. We're now back to £12,000 of cost of sales. Works out beautifully. £48,000 of profit and 80% profit margin, as they call it. You can't see me doing the little bunny ears, but that's what I'm doing. And as you can see, we've only made 30 grand now. If we flick back to the original, it was showing we made 36. Now, if we'd left it like that, apart from this would show unrealistically, and later on as your business grows, these figures become extremely important. I mean, they're extremely important from the beginning, but when you're looking to use them as a tool for growth and how you could grow, having these off is a really, really bad idea. And you can see it's then made more profit. Now, apart from being wrong, it also means that you're going to pay more tax than you should. Now in here, we've adjusted it down. You can see we're not going to pay as much in tax. So it looks much better. We've got the chairs. And that's it. They are the main effects, so it's really important to know. And what you might see is quite often, if you've got thousands and thousands of lines in different bits and pieces like that, your accountant normally will say to you, look, you need to go and do a stock check. We need to know what the value on hand of cost stock is. And the reason that is as you can imagine, we can't necessarily do that as we could in the simple example here and just work out how many chairs we had. You need to go and do a stock take and get a value here. And as you can imagine, any differences then ends up sitting here. Because what can happen as well is you can have things like a chair might have broken or a chair might have been stolen, and as a result you need to reflect some of that in here as well. So and this can actually make this a bit worse. So there's all these things going on, but it starts from knowing what this is. If you know what your stock on your balance sheet is and you know what the value should be at cost, then therefore the rest of it ends up realistically getting adjusted in here. So there you go. But it does give you an idea of both. So for me, the takeaway points when you're looking at this is check your margins. Are you happy that this profit and this margin accurately reflects the amount that you sold? If you look at the amount you sold, does that figure get anywhere near what you expected? If not, that's a big red flag. But the main one for me is if you're looking at the stock and the stock is vastly higher than what you've actually got, when you look around your shop and think at cost price, there's no way this is here, then you need to take that stock check and go and discuss that with your accountant or your bookkeeper. Or if you're doing this yourself, make sure that this is right, and especially if you're self-employed, because this is going to make a massive deal on your stock. So there we have it. There's some key points to talk about why your stock is important. It really is, both as a tool and both for your tax bill. If you've enjoyed this video, be sure to check out the other videos in the Know Your Numbers series, because I think they really dig deep into some of the things we've discussed in this video. Share it with your networks, like and subscribe, and we'll see you in the next one.